Hey guys, my name is Nicolette Mashile. I am also known as the Financial Bunny. Welcome to the Financial Bunny TV. Happy New Year 2025. Here we come. Congratulations for making it into 2025. It is only the strongest that make it. So today I want to talk a little bit about 5 lessons that I have learned from Benjamin Graham's book, The Intelligent Investor. An absolute masterpiece when it comes to what type of mindset you need to have and what tips and tricks you can use if you are looking to become an investor, right? Especially within the stock market. But I do think some of the lessons that are in this book are generally lessons that we all can use in different types of investment vehicles or asset classes. So I'm going to go through 5 of them and I'm hoping that they can assist you. I'll try and explain each one so that it at least is not just relevant for the stock market, but you can apply it somewhere else. The first one that Benjamin speaks on, or rather the first one that I really loved, was this idea of investing with a margin of safety. Now, what is a margin of safety? A margin of safety is if you go on to Easy Equities, for instance, and you find out that the Capitec stock is selling at 1,300. What you need to do is to try and buy that stock below its intrinsic value. So below its real value, right? So if the stock is at 1.3, you need to try and buy that stock at 1,000 Rand, right? Because you give yourself that breathing room. Say, for instance, it loses, the portfolio loses that valuation of 300 Rand and it actually comes and settles at 1,000 Rand, then at least you would have bought it with a margin of safety. The other example I can use to try and explain margin of safety, and I always use this example. So there's a young lady who contacted me. A couple of years ago, there was a DJ who was telling everybody, buy a property is the best time back in 2020, right? While he wasn't wrong that the market conditions were ideal for buying property. Why? Because property is one of those asset classes that banks are willing to finance, right? So one of the investment asset classes that banks are willing to finance. And at that time, debt was actually cheap because the interest rates were lowered to try and stimulate some economic growth. So of course he wasn't wrong, but the reality is that, and these are some of the things that we've learned over the years. Personal finance is personal to you and me. Personal finance is personal to you. Personal finance is personal to the next person. It's not group work, so it doesn't look the same for all of us. So just because the market conditions are great for you to invest in property doesn't mean you must go and invest in property, right? You need to be in a good space financially to be able to invest in property. Anyway, this young lady did go and invest in property. She bought a 1 million Rand house. At that time, she was paying 10,000 Rand. I'm really using these numbers as illustrative purposes, so don't take me for word. So let's say she invested there. She took it on a variable rate. Now, the variable rate versus the fixed rate, right? Variable rate is the one that changes when the prime lending rate also changes, obviously, due to the fact that the repo rate would have been changed, right? So between 2020 and 2024, now we're saying in 2025, we know for a fact that the interest rate had to come back up, right? So Lesotho and the boys had to bring it all the way back up because now they're having to fight inflation, right? So it changed quite dramatically between those years. But that also means that her installment also changed. So let's say in 2020 she was paying 10,000 Rand. It means that in 2024 she potentially will be paying around 15,000 Rand. And she contacted me and said, Nicolette, I'm actually struggling with this loan because I did not budget for more than. And remember, with the property, it's not just the installment that you are paying, it is also the city of the municipality that you live in, and if it's a sectional title, you're also paying levies. So there's quite a lot of maintenance and operational costs that come with the property. So you've got to work that into your budget. And now all of a sudden your installment is 4,000 Rand more than what it was. Where are you going to make room for that in your budget? And that's why the margin of safety kicks in. So people say, yeah, but the bank is not going to give her a fixed rate. Granted, the bank might not give you a fixed rate. You can't control that, but there is something you can control, and that's buying within your margin of safety. So instead of her buying the 1 million Rand property that was going to make her pay 10,000, which was the ceiling of how much money she had put aside for a property, she should have bought a little bit lower, 700,000 Rand, 600,000 Rand apartment. That gives her that margin of safety, that if something is to happen, interest rates shoot up, levies and taxes go up, then she's got that margin of safety, because from there, her installment might be 6,000, 7,000 rand. She's got that 3,000 rand to play around with. That's the importance of margin of safety when it comes to your investment. So it's a very clever way of investing, right? The second one that you need to think of, or lesson that comes up, is you need to know the difference between investing and speculating, right? A lot of us try to speculate. A lot of us try to time the market. Speculation is basically gambling. It's you saying, I don't know what the fundamentals of investing are, but I'm going to take a big gamble here. Now, that may sound very incorrect, because I'm assuming that people even who do betway, especially football betway, you're looking at past performances of a football club. You're looking at the current form. So if, let's say, you've got an Arsenal playing Man United, we know what happened in the last game. However, you're looking at current form. You're looking at players. You're looking at strategies. You're looking at past performance. So you basically are using some factors for you to be able to take the gamble, right? And it's a similar thing that you should not be doing, because in finance, what we have seen is that past performance is not indicative of what the new performance is going to look like. We've kind of seen that already, right? So it's very difficult to make money in investing with speculation as the front runner of your decision-making process. So the best thing is to use the principles of investing. Understand what is the timeline that you've got. How much money do you have to invest so that you can pick the right asset class? What is the goal or the investment outcome that you want? What type of risk are you willing to take? What type of taxes you may be liable for on this specific investment? All of those should then give you the investment that you should be looking at, the types of stock you should be looking at, the types of whether you're going unit trust, or whether you're going exchange traded fund, or whether you're going TFSA. Those factors should make you build the type of investment versus you are chasing the hot stock. I always see people saying, which stock should we be buying this month or this year? Or which company should we be buying into? And I'm like, relax. Before you start chasing the actual investment vehicle, ask yourself these kind of questions. How much time do I have? How much money do I have? What is the outcome I'm looking for? What kind of taxes am I going to pay? What kind of fees am I going to pay the financial advisor, right? And then what did I say? Yes. So we spoke about tax, we spoke about timing, we spoke about how much do you have to actually invest, what is my risk profile? What is your risk profile? And also, what circumstances do you have that may potentially change your risk profile? I'm 36 years old. I don't have kids. If I die, I die. But if somebody else who's my peer, who has the same age, but maybe has 2 or 3 kids, they need to think differently about how they do their estate planning, what type of investments they have, and if they're married, what type of marriage regime they're in, because all of those things will ultimately count at the end of the day. Whereas with me, I can invest in much more riskier stuff, so my circumstances don't necessarily influence my risk profile that much, whereas somebody else who has dependents, theirs might influence that. Right. And then the third one you need to think of. It's important to think of investing as a long-term journey, right? A lot of people want investments to be quick returns, and I was actually telling somebody, it's very surprising how impatient I am with everything else except for investments. I've kind of gotten into my head that I cannot be impatient when it comes to my investments. I take my time when it comes to investments. It's the one thing I'm prepared to actually be a patient human being, right? So when I explain investments and savings to a lot of the youth people that I speak to when it comes to finance, I use that apple theory, and I say, the 8 apples, you can do whatever you want. The 2 apples are holier than thou. Apple number 1, deep freezer, we call that your savings. Apple number 2 goes outside underground. And then that's when I start teaching the principle of time. Because remember, you can't go to a lady who's just conceived a baby and say, where's the baby after 2 months? You've got to wait 9 months. Same way, someone is in a 3-year degree. You're not going to ask them halfway into the degree, right? Or the tree that still needs to grow, mature, then fruit. You're not going to rush it because you understand that you have to wait. That same principle of understanding that there is a waiting period for your investments to give you results and returns is the same principle that you need to understand and instill in yourself so that you don't find yourself rushing your investments. And that's why we have different types of investments. We've got short-term investments, we've got mid-term investments, and we've got long-term investments. You can't want your long-term investment to give you results within 2 years, because then those should have been your short-term investments. And your short-term investments and your long-term investments may look different. The types of asset classes you're going to invest in, because on a short term, the timing is much shorter. So it means that you need to look at an asset class that's going to give you the desired outcome in a far shorter time. So the stock market might not be the ideal place, because the stock market, if tomorrow Vodacom shares plunge down and you've got, a gazillion of Vodacom shares, and it takes the next 18 months for those shares to recover, in 2 years, you're going to make a loss, because you're going to come out where the shares are low. So you're no longer buying low and selling high. You've probably bought high and now you have to sell low. That's where you actually incur the loss. So I always say on this channel, remember, when it comes to the stock market, if you log into easy equities and everything in your portfolio is red, stop panicking. Wait for the market to rebalance itself. Wait for those shares to bounce back. The only time you're going to incur a loss is when you actually sell those assets or sell those shares. Because we always say, buy low, sell high. But if you don't sell, you wait for the market. Look, in some instances, you wait for the market and the share just never bounces back. Steinhoff. We've seen now with Sasol. Sasol is taking the biggest beating, right? So it's also important to look at the asset classes that you actually are holding on to. And that's why I always say, funds in South Africa look the same. Most funds look the same. It's the fund manager, it's your financial advisor that's going to make a difference in terms of, do you win or do you lose? Lesson number 4 is to be a disciplined investor. Don't jump from one thing to another. Too many of us like to jump from, today it's property because Nicolette was speaking about property. Tomorrow I'm going to consider the stock market. Then I'm going to consider livestock. Then I'm going to go into student accommodation. No, you need to be a disciplined investor, that you are not swaying and moving with the market. Remember, in this day and age where technology is so advanced, information about investments, markets is everywhere. You log into Twitter, you're finding it. You log into Facebook, you're finding somebody giving you information. The newspapers are speaking about it. There are various news outlets. There are even curated investment news outlets now that give you this information. So you are constantly being bombarded with information. And if you're not a disciplined investor, you're going to think that you need to make a decision based on that information all the time. So in the book, he also speaks about Mr. Market. So Mr. Market is this fictional character that is meant to symbolize, the market sentiment and the market behavior. And he says, sometimes Mr. Market is going to give you information to sell or to buy more, because it's the market's voice that's going to be in your head all the time, right? So going back to a principle that we are taught by Warren Buffett, where he says, when the market panics, you don't panic. So think about it this way, and I love using this analogy when I teach young people. I say, if you, let's say, for instance, you've decided that you are going to put aside 1,000 Rand every single month to buy investments, and you decide that you are going to be buying livestock. And let's say, for instance, livestock is 500 Rand per cow. And you keep doing that every month. Whether the sun is out or the sun is not out, you are buying cows every single month. 2 of them at 1,000 Rand because they're 500 each. In the month where there's maybe a mad cow disease and the market gets flooded by cows because law of supply and demand, right? So when there's a mad cow disease, the market panics. The market says to you, sell, 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 sell. You need to keep composure. You need to say to Mr. Market, oh, no. Remember, because you know why you were investing in cattle in the first place. You know that the mad cow disease is not a permanent thing, right? Yes, the portfolio has lowered. So your portfolio has lowered. So let's say maybe it's in month number 3. So already in 2 months, you've bought 4 cows. Now, let's say the cow price goes to 250. So you've already spent 2,000. However, 4 cows at 250 is going to be, it's going to be 1,000 Rand, right? So essentially, you've lost half of the value of your property, right? But you don't panic, or your portfolio rather. You don't panic. You keep buying, because in actual fact, when the price of the cattle is now low. It means with your investment, you are able now to buy 4 of those cows instead of the 2 that you were buying every month. So basically, you're in a sale. Right? So you must be that kind of investor who is disciplined, that even when there's market downturn in the types of investments that you're buying, if you know why in the first place you picked that specific fund, it's like unit trust. When the unit trust goes, the price of the unit trust goes lower, don't panic. Be a disciplined investor who stays invested. And that's why the hand holding of a financial advisor or a wealth manager is very important, because your wealth manager is the one who's supposed to tell you, you know what, we keep going, we keep holding on. Because in most cases, asset classes are going to bounce back. So you need to stay balanced. You need to stay disciplined, and you need to stay consistent. And the last lesson is that the stock market, Mr. Market, right? I spoke about Mr. Market a little bit. He is there to take instructions from you and not to sway your strategy. Because Mr. Market, as I've already indicated, will give you all types of information. But remember that Mr. Market and the market that we speak about is basically other people who are also buying and selling the same types of investments as you. So where there is panic, okay, so let's use the cow analogy again. Where there's going to be panic, so what happens is people are going to flood the market now with cattle, right? Because there's a panic. So Mr. Market is telling everybody, sell, 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 sell. Now what you then do is, if you change your strategy and you also start selling, you're expecting somebody else to buy these assets from you so that you make some money out of them, right? However, somebody else's Mr. Market is also telling them that buy, which is where you actually need to be, because you're the one who's in a sale. So you need to stick to your investing strategy, because Mr. Market is going to be telling different parts of the market what to do. And when people change their strategies, that's where sometimes it goes all wrong. Think about it this way. Mad cow disease goes away, let's say around about June. Fine. Again, you're back to buying 2 in June. July, you buy 2. In August, you buy 2. But a country like South Africa, September to December, Qimbi season, sana, it is weddings, it is Thanksgiving, it is graduations, it is all sorts of types of micimbi. And we know in African culture, our micimbis need cows. The cow must fall on its 4 knees. Is it knees? The cows have knees? But it must fall nonetheless. So now the law of supply and demand comes back in, right? The supply may be low. People are not willing to let go of their cattle, but the demand is high. So now who sets the price? The supplier. I have the cattle that people are looking for. So now I'm setting the price. And I'm going to say my cow is now going at 2,000 Rand for a cow. Do you understand? You didn't let Mr. Market make you panic. In fact, you didn't take the instruction Mr. Market gave you of sell, sell, sell. Instead, you heard Mr. Market and decided that actually, because of my strategy, I'm going to hold. Mr. Market doesn't instruct me. I instruct Mr. Market. I tell the market what is going to happen because I have an investment strategy. So those are the 5 lessons that come from the book, The Intelligent Investor by Benjamin Graham. I think it's a fantastic book, especially if you're new to the investment world. As I said, he wrote it with the stock market in mind, but most of the principles of investing are very much applicable to any other asset class or any other investment vehicles. It's really about extrapolating the most important parts of investment principles, the mindset that you need to have so that you find yourself in a situation where you become an intelligent investor. I hope this has been a valuable video for you. Please remember, none of my videos constitute as financial advice. If you are, however, looking for financial advice, please speak to somebody that is certified and registered with the FSCA. Mwah.